Think about your environment. Who are the 5 people that you surround yourself with, that you spend the most time with? Are they having a positive or a negative influence on you? I can cover a lot more ground digitally versus probably pounding the pavement.
No, tenants sometimes don't pay rent, and it's just because they're a business doesn't mean they're also going to pay rent either.
You can listen to podcasts, you can read books with people. That's really one of the biggest accelerators. You can do all this stuff, but until you're in the right rooms. What's going on, everybody? Welcome to another episode of the Commercial Real Estate Blueprint Podcast. I'm extremely excited for today's guest. We have Sean Katona. He is a commercial real estate investor, a landlord, just all-around awesome guy, and from what I can see, a great entrepreneur. So we're really excited to have him on the show, and thanks so much for coming on.
Well, I'm excited to be here with you, Graham and Jesse. I know we were talking about this for a while, so it's fun to be doing it, especially with us coming to visit your backyard. So all the stars are aligning.
Yeah, definitely. I first got introduced to Sean last year when I went to a Commercial Academy event in Orlando and watched him get up on stage and give a presentation on how he markets things. I've been in commercial real estate for almost 7 years now, brokerage-wise, and the way that he markets things is wildly different than, I'd say, 98% of commercial real estate brokers and landlords. So I'm excited to get into that today, too.
Yeah, definitely. Fun stuff.
Awesome. So for the people who don't know you, give us a little bit of your backstory and how you got into commercial real estate specifically.
Yeah, sounds good. I think my journey started like maybe a lot of people out there. I was working in corporate America. Folks told you to go to a good school, get a good job. So I worked at a tech company, specifically Microsoft, for almost 5 years. And as I started to save some bonus checks, I was like, hey, I'm going to invest in real estate, like the book Rich Dad, Poor Dad taught me to do. And I went out and bought a rental house that was negative cash flow and accidentally flipped that for a decent profit and was kind of like woken up to, hey, maybe I should flip some houses, buy some more rentals, and fumbled my way through that for a few years. I was eventually smart enough to go get a coach and a mentor to kind of guide me through that, to take it to the next level. And so I focused on residential for quite a few years. And I went from doing, 6 houses to 12 to having actually, I think it was 15 construction projects going simultaneously with 3 different GCs who had all under-promised and over-delivered. Oh, no, wait a minute. Over-promised and under-delivered, behind schedule, over budget. And I remember feeling like an adult babysitter at that point. I was like, what am I doing? I got into real estate for cash flow. Now I'm just a construction manager. And it really pushed me to take a closer look at commercial real estate because, you did the math on it and I could do a single building that would probably equate to 10 or 12 rental houses. So it just made more sense, or maybe dollars, if I want to be cute with it, that to build more passive income, let's do bigger, higher quality deals. So I finally did that a few years later, and I got into a little bit of a groove in retail, strip malls, shopping centers. And while I live in Southern California and I looked all over the whole West Coast, really settling in on Arizona and Greater Phoenix specifically. So today that's where I'm focused and what I'm focused on. Nearly a dozen transactions there of a few different shapes and sizes. I tend to go buy fixer-upper deals. Definitely have some hair on them and are underperforming, and get them dialed in and either, keep them for cash flow or sell them for what ends up being a pretty good profit, if we choose to part way with the deals. So that was a lot, but maybe that addressed some of the background.
No, I think a lot of people start, in corporate America. That's a very common thing. For me, it was the military. Leaving the military was a little bit different too. But, it's cool to see the journey and that you made this successful jump. I think a lot of people start in that residential stuff. That's where me and Graham started. We had that, okay, this Airbnb thing is kind of working, even though we were just in Durham, North Carolina. We thought that was kind of cool. We're like, maybe we should rinse and repeat this. And then the Airbnb bookings started to not come as much. And, so we were like, well, maybe we should try commercial. And we bought our first building and we saw that, being able to lease it within a couple months. And now it's cash flowing pretty good and we're able to pay off investors. I personally was inspired when you came to Commercial Academy last year and you were talking about, well, I didn't really know what I was doing, but I had a mentor and I found a good deal. I locked it up for 25 grand and you were just all about taking action. And I really respect that. I'm curious what made you choose retail out of all the things and all the markets.
Yeah, no, great question. I didn't get that precise and that focused initially, and I think that's probably something that cost me a lot of time and a lot of money, and it's why I'm sensitive to share that with either existing investors or aspiring commercial investors now. Is trying to cover the whole West Coast in multifamily and retail, and I don't know, maybe light industrial. That's a lot of markets to know. That's a lot of different asset classes to know. There's different brokers for those towns. There's different brokers for those asset classes. And so I think I started to recognize that I wasn't good at any of those, like jack of all trades, master of none, right? So when I really started to hit a stride a little bit better, it's because I just kept looking and looking and looking in the same market. I started bumping into some of the same brokers, and I'm starting to see more familiar names. It's like, oh, this guy's got signs all over town. And then you start to see, comps that are recognizable, and what rental rates are a little bit better. And I think at the end of the day, what that's helping someone do is distinguish more accurately and probably more quickly what's a good deal versus a mediocre or a terrible deal. And I think that helped me to recognize, oh, I've really got something here. When I finally got my first deal under contract, it's like, hey, this has a lot of upside. And this is performing pretty well, but the bank isn't doing a good job of managing it. And I think it checks all the boxes of what makes, decent quality retail in, greater Phoenix in my case.
No, yeah, that's such a good point. We've actually touched on that before. When I first joined CityPlat, they happened to be buying a lot of stuff in like the Triad area. And so I pulled a list because I was a new broker with them and wanted to help them buy more deals. That's kind of why I joined. And I pulled a list of deals in that area and just started calling it. And like you said, you just start to run into some same owners, same brokers. You start to get a feel for the numbers. You just start to get a sense for the market. And that becomes invaluable because then you can, like you said, a lot of what helps people win in real estate is their speed to action. So if you see something that's a good deal and it's a good deal because you know the market like the back of your hand, you can act on it. Versus like if you're looking at 10 different markets, like you said, and talking to all these people, it's like you might think, oh, maybe that's a good deal, but I'm not 100% sure. Let me look into this a little closer. And then the guy who's focused on that market is going to come in and scoop it out from under you. So I think that's a very important point, that it's easy to look all over the place, but it really, really helps if you can niche down.
And I'll add to that just a bit more. It's interesting now because, people know that I tend to, focus on Phoenix and retail. And so I'll have folks sending me deals and I go, oh yeah, that's interesting. I offered on it 3 months ago, or I looked at that six months ago. And so, and here's why I passed on it way back then and way back when, by the way, when the price was $1 million lower. So yeah, I think what's tough is in the beginning of folks' journey, I bet they spend and waste a ton of time on something that I can recognize in 1 minute is not worth really diving much deeper into, at least for my buying criteria. And that obviously wasn't the case in the beginning. I spent a lot of time trying to figure out what is a deal and what's not, and what's going to make sense for, my buy box at this point in my journey. We're in the portfolio building mode versus just sit back and collect cash flow.
Yeah. No, that makes sense. Going back to talking about the residential stuff, do you still have any of those initial residential properties, or did you liquidate them all and move all the way into commercial real estate? Or I'm curious.
Yeah, just about. When I was doing house flips, there was many of them up in Seattle, where I'm from originally, and I kept a few of those as rentals. But when COVID went down, and that was a really tenant-friendly area, and no one was paying rent, and I couldn't enforce it in any way, I was like, I am not enjoying this, and I think I'm going to take some of that sleepy equity that I had sitting in those deals and put it into more shopping centers in Phoenix. So it was a landlord friendly state, and commercial real estate, doesn't have to worry so much about some of the consumer protection stuff dealing with housing. So that made a lot of sense. I still have a couple of my Texas rentals from way back in the day. Those were bought like through a turnkey rental provider, and they'd buy them, fix them up, and sell them to you for whatever it was, an 18% cash on cash return. So I guess in hindsight, I wish I would have bought 10 more of those with my 4% mortgage rate. That have just steadily gone up in rents, and the loans pay down, and they've doubled or tripled in value now, and time just does wonderful things here a decade later.
Yeah. I'm curious. So, you went from Seattle to Phoenix, and then you said you live in Southern California. So I think one of the cool things about commercial real estate is it's easier. I mean, I think so, at least. It's probably opinion based, but it's easier to remotely acquire and manage commercial real estate than is residential real estate. And something that, Scott Scheel and Commercial Academy talks about when I was at the event last year was how you can, you need to be you can buy in 5 different markets, because if you focus on one, then, you might not see as much action. But I've seen kind of some people say do that where you can have more opportunity. And then some people say, focus in one area. What's your perception on kind of balancing that because, we just talked about the focus being valuable, but at the same time, like Durham, where I'm at, there's, not a lot of whole lot of volume. So you might not be able to buy as many of these deals. Like, how do you balance that as an investor?
Yeah. So I guess kind of building off my own experience and journey, it's like when I started looking at multiple markets and like if you think you pick 5 markets and 5 asset classes, well, that's 25 combinations that you could have to figure out. And this is already a little bit overwhelming, for someone just learning commercial real estate or real estate in general. And so I would gravitate more towards start extra focused. And if you feel like you've saturated every opportunity and every broker and every pocket of town, or maybe a more extreme example is, if you live in Orange County, California, and every deal trades for a crazy price per foot in a unexciting cap rate, and people are just happy to play defense here, that might be a reason to look at, maybe the suburbs or go out to a place like Phoenix where, in my estimates, I make about double the cash flow or double the cash on cash return by flying over to Phoenix as I would in my backyard. And so if I'm doing a buy and hold and a cash flow strategy, that to me is worth, not being able to drive it and see it, every week. I'll go there once a quarter at least, or maybe once a month when I've got some active stuff going on, but there's not that much that I need to see day to day about it. And I think I see more people struggle with the overwhelm, then there's not enough opportunity here. And probably what's really happening is they aren't recognizing an opportunity. They don't know how to source deals. They don't know how to present themselves to brokers. They don't know how to talk efficiently and effectively to owners. They don't know how to consistently bring in deal flow, whether that's through, direct marketing or, use some of the online tools that are available. So, if you're a newbie going out there trying to get going on your first deal and you barely understand commercial real estate and you've not negotiated dozens or hundreds of deals and you don't have the tools and you don't have the resume and you don't have the track record and you're competing against guys like City Plat or someone who's got a dozen or half a dozen deals, that's not an easy thing. And if you put your broker hat on, which Graham, I know you can appreciate, you'd rather probably send a deal to someone who's a known closer, who you've transacted with multiple times, who has a track record, who's got cash in the bank or investors lined up or a fund in place and that is going to close a deal versus the guy who's trying to figure it out. It's just, they're probably going to have a few false starts and things that make them skittish and scared and not recognize it. And they may be 30 days into due diligence before everyone realizes, this is a little thin for my liking. I over offered by $500,000 to $1 million. Let's move on. Great. You've wasted everyone's time for the last 45 days because you just haven't had that much practice and gotten that many reps in because you haven't done this before. And that's the beginner's journey.
Mm-hmm. I was going to say the natural question next is, how do you bridge that gap between I'm a new investor to getting to, hey, I've actually done some deals? Like, I know obviously the quick answer is, yeah, I got to buy some deals, but how do you get into those brokers' shoes? How do you raise the money? How do you, pitch to investors, hey, I can actually make you money here?
Yeah. Couple ways. I got a lot of reps in by offering on a bunch of deals and getting rejected on a bunch of deals, and then even getting traction on many deals through non-binding letters of intent, only to have those maybe scrutinized and picked apart and dissected and ultimately killed by, what I call my Jedi Council, more seasoned eyes and more seasoned guys and gals looking at those deals going, oh, by the way, Sean, this has low traffic. This has low population. This has shitty visibility, all these things. It's like, oh, well, I didn't think about all those things in the beginning because I didn't have a tightly typed up buying criteria. And I just thought, oh, it was a good price per foot or, something a little more one dimensional in your underwriting. I know by watching other guys and gals close on transactions, you started to see the ones that passed the test versus those that got rejected. So you kind of got a lot of reps in that way. Another thing that I think is helpful for many folks is to ride in the passenger seat, or go along with somebody else who does have a great resume and a great track record. And you can do that, by being a limited partner or a passive investor and say, like, I've got, 50 grand to invest in someone's project and these guys have a great thing going and I believe in this area and I believe in this building. And now I get kind of see from the inside how they bought it, how they lease it up, how they bump rents, how they handle some of the construction. And you're not necessarily doing it all yourself, but you're really seeing maybe secondhand how really successful guys do it. And you might pick up on a lot of their best practices, model, some of what you do after what you're seeing them do. And you'll probably be a lot more focused because you've written a check and you're in that deal, right? Or, Graham, maybe you've experienced that as the broker. You're like, well, I helped define this deal. I'm on the leasing assignment now. Our intention is to fill it up and then flip it on the back end. So you might be making commissions 2 or 3 different ways. And so you're probably very aligned with the owner and the landlord's success. And you're getting incentivized that way. And the limited partner would be too. So I think, those are 2 interesting ways to do it. And I'm sure we'll talk about this, but having access to coaches and mentors that can really help you see those things that you may not see. And you guys have probably heard that saying, like, what you don't know, but then there's the stuff you don't know. And there's certainly a lot of that going on in commercial real estate, especially if you're getting outside of your backyard and markets that you think are good. You might end up in a pocket of town that no local would consider investing in, but you're like, yeah, I can buy a 10 or a 12 cap here. Well, that's because there's some things that you may not love about it that you may not realize right now.
Yeah. No, that's such an important point, and we've touched on it several times on our podcast, that just making sure you don't go out and do, it's definitely possible to go out and do a deal by yourself, but it's definitely not the best course of action. Like you said, whether it's getting in as an LP investor or just having a small equity stake, or even like, me and Jessica started this way, being a broker, it's not a bad way to get started. But that's exactly why I made the switch to CityPlat, because I knew that I wanted to be around people buying deals so that I could be in the passenger seat and watch them. And, at the time it was a very stressful decision, and I didn't know if it was the right move or not, but I did it. And looking back over the last 2 years, it's been, one of the best decisions I could have possibly made, because I'm fortunate to be around, awesome investors and awesome group of people that I've learned so much from. Like, it just can, it's probably the number one thing that can accelerate your learning. And it's interesting because CityPlat attributes a lot of their success to Commercial Academy. You're in Commercial Academy, and I'm sure a lot of that success is from that. So talk on that a little bit, like how important being in that group is, or, other mentorship groups, or, how has that helped you in your journey?
Yeah. No, great points and interesting thoughts. I would compare it to, if you're trying to learn Spanish and you're reading it in a book or you're using one of the apps, versus, hey, you took a trip to Mexico or Spain and you stayed there for a month, and, you're really disciplined to just speak Spanish, and, you're going to pick up so much more, so much faster, because you're in complete immersion. So, Graham, you're getting that on the brokerage side. And I would say, being part of a group of other, full-time landlords who are completely focused on commercial real estate, and all they think about day in and day out is how do they buy more property? How do they lease it up faster? How do they raise more capital? How do they attract more talent? How do they build bigger teams? How do we improve every aspect of our operation? How do we become the savviest, group of investors that we can be? And we're sharing a lot of stuff with each other. Well, it's almost like an unfair advantage compared to someone else out there who's a hobbyist, kind of dinking around here and there, or, the guy who can maybe only spend 5 hours a week doing this. It's tougher. So, think about your environment. And, I often ask people, who are the 5 people that you surround yourself with, that you spend the most time with? Are they having a positive or a negative influence on you? And, you're in there sitting with other multi-millionaire commercial real estate investors and landlords day in and day out. You're going to start to think like they do. You're going to talk like they do. You're going to pick up all those habits. And it's like almost through osmosis, you're getting decades of experience by being able to see all those transactions, all those, negotiating lessons that they've learned the hard way. And it's probably, the best thing I know for how to increase someone's odds of success, and then also compress decades, down into, a year or months or even weeks in some cases.
Yeah, that's so good. So talking about the deals you're buying in Phoenix, you touched on a little bit that you fly there maybe once a quarter, or if you're more active, maybe once a month.
Yeah.
Like, how involved should somebody be going, out of state or out of market when they're looking at deals? Like, do you have a team in place? I assume you have property managers and brokers you trust, but like, I guess, what does your team look like, and how involved should somebody be when they are buying out of state? Because that's something I'm curious about.
Yeah, that's a great question. And there's a little bit of an evolution too, because when I first started, I didn't own an asset in Phoenix, so didn't have any in-place team or resources or the things that I have today, property management that's local, people and many broker relationships and many vendor and lender relationships. So as it's gone, all those things have, built over time. I did spend a lot of time on LoopNet or Crexi or whatever your tool of choice is, looking at a lot of deals, getting familiar with it. So I think someone should spend a lot of time doing their desktop analysis, desktop underwriting. Can you rattle me off the rents of certain pockets of town? Do you know what the vacancy is in a certain area? Do you know who the key brokers are? So that when you go to town, and what I tend to do is like 2 days, I can book meetings from morning to night and a dinner and a happy hour and coffees and meet with all the key players that I can and have a really productive, really efficient trip. I just got back from one a week or two ago, and I was less prepared on this trip. I didn't set up a ton of meetings. I didn't, meet with a lot of the folks that I do just because I did it kind of last minute to go check on 3 construction projects. And I felt unprepared to go look at deals. So you can drive around and, kind of get acquainted with an area and like do the driving for dollars. But I would much rather have picked out 10 deals I was excited about that I had talked to the broker on, ideally that I've submitted a letter of intent on and had some sort of traction going here. Now, maybe they countered me. Maybe they told me there was no interest. Maybe they told me they'd feel more comfortable if I had, already toured the property before offering. Well, now I know I've got something that's going somewhere versus the much lower likelihood of deals progressing down the pipeline. So I want to do, let's just put it this way. I can cover a lot more ground digitally, versus probably pounding the pavement. And, when I'm away from the family and I've just got, 2 key days on the ground, I want to have it really organized and really well put together. And, that's just my personal preference now. But if you're not worried about getting back to the kids or being away from the family and you can spend a week there and just really get a feel for the town better, great, do that. And so I've taken a lot of trips to Phoenix over the years, and I've gotten a lot more familiar with some of the pockets I like and some that I don't. And, some of the little nuances. And you probably know that in your hometown, in your backyard. And so you'd want to get to know that in any market that you're going to make investments in, especially if you're going to do multiple like I ended up doing. And what's funny is today, I feel like I know the Phoenix commercial real estate, specifically retail, way better than what's going on in Orange County. Like I couldn't tell you the rents here, the cap rates, because I never look. I don't talk to the brokers here. It's just like I am singularly and solely focused on my market and my asset class, because I could probably buy $1 billion of real estate there before it was tapped out or saturated. Haven't done it, but there's that much inventory available in a market of that size.
Yeah, no, that's awesome. That kind of segues perfectly into what does your portfolio look like now?
Not that huge. I've only got 4 buildings in portfolio at the moment, a couple of different shopping centers. I did just sell one back in April that I worked on for about 3 years. I think I bought 9 or 10 deals now. And I've also passively invested with other guys that I really like and know and trust, who are experts in their markets and in their asset classes. So I feel like I'm actively managing those 4 deals, but I also do that more or less on my own. While I do have property management, who takes their monthly fee that the tenants pay, I don't have a partner in my business, or, I don't have 4 principals that I split things with. I have the GP and the LP split. There's my wife, but, I often feel like the CEO and the janitor and everything in between. So there's not so much of a portfolio that I can put like a ton of team on it and economies of scale, which is probably a better level to get to, so that I can focus more of my attention on the things that pay better, things that are, in my unique ability, things that, I enjoy, versus like, I just want to blow my brains out when I'm dealing with this construction management. It is so tedious, and it's just got to be done, and it's got to be managed, and there's big dollars at stake. So I do it, but I would much rather go find the next deal deeply discounted, or, raise the equity to take that deal down, so that I can continue to put stuff in my portfolio where we own 50 to 75% of the equity in a lot of the cases. And that's kind of the inverse of what you see in many of the bigger deals or more institutional ones. And I've been able to do that in part because I've got deeply discounted deals, and I've got seller financing, and I've got excited investors that want to come alongside, and I can deliver them great double-digit returns, but, still keep the lion's share of the equity. So that was a long rant. I don't even remember what the question was.
No, you're good. You kind of led into another question, which was Like, how do you structure these deals? And you answered a little bit, but you said you're a GP and you have LPs. Is it different case by case, or do you have like a general structure you stick to? Or
Yeah, mine's pretty straightforward, and I think it's what a lot of us in our group do. It's a syndication. We'll do an operating agreement, like a PPM. I'll only have probably 3 to 5 investors on most of my deals. These are all folks that are accredited. I've got long-standing relationships with them. Almost all of them have come back into more deals as I've continued to buy them, sell them for double, make them great returns. They go, okay, what's the next one? But I'll go get the best debt that I can. So if that's seller financing, wonderful. That might be 70, 80. I had one guy do 88% of the capital stack. And so we were able to come in with a very minimal down payment. And then those friends, family, acquaintances, country club money, they come in as their, as partners, as owners. They're limited partners who are check writers, and they get their percentage of the deal. I have personally not done a whole lot of pref returns where someone's getting the first 6% or 8%, in part because I thought it was maybe unnecessarily complex. I've also seen deals where sponsors get eaten up by the pref and they've got multiple deals to manage, and all of a sudden they're starting to play favorites with the ones that they're getting paid on. But I've also kept my fees very low to almost non-existent, which is a little bit different too. And like, wait a minute, I'm kind of picking my own pocket here in fees and this and that. So that's been what my structure has been historically, and proud to say that every deal that we've done so far has gone really well. We've been able to sell all of them for 7-figure profits, and often double the value of the property. So when you can do that, you can eat well as a sponsor, but still give killer returns to your investors. Yeah. I think that's a win-win.
Yeah, I think going back to the talk about focus, like you're not able to find a deal every single day that you're able to buy for $1 million and sell for 2.5. It's just not going to happen. I think that focus is able to you're able to find those deals less often, but it's what keeps you in business too at the same time. Something that I remember you were talking about back in Raleigh last year was you had a seller finance deal, wound up, I think, selling that deal, and then you took that debt and bought another property with it. You mind talking a little bit more about that? Because that's not a very common, you don't see that very often.
Yeah, that's right. So let me maybe add a little more context to it. So
yeah, please.
That shopping center that I sold, about a year ago did have seller financing, and kind of a funky story is halfway through that deal, I needed more money for tenant improvement allowance. We were building out a big laundromat and a big preschool, something like $300K that needed to reimburse the tenants. And at that point, I'd fully leased the building, roughly doubled the value of it. And if you're working with a traditional lender, bank, credit union, whatever, you'd say, hey, I'm ready for my good news money. I've got all these leases signed, like release the difference of what we set aside, or let me increase my loan balance, tap into the credit line. In this case, I went to my existing seller financing and had that same conversation with them. We've doubled the value of the building. The cash flow is doing great. I need a little extra money here to square up my tenant improvement allowance. And they were willing to do that. They just increased the loan balance, did a cash out of a couple $100,000 just a few days later there. And so I continued to pay my, whatever it is, 7.5% interest just on that larger balance. And I think, Jesse, your question was, when I went to sell that building, what do we do? So sold that property. And as we were doing the payoff demand, I reached out to him and said, hey, I'm about to pay off this loan. You're going to stop making the 7% interest that I'm paying. Would you be interested in continuing this loan? And what we'll do is, instead of securing it against this property in Mesa, let's bring it over to my other property that I already own in Phoenix. And so that Phoenix property, I think, had a $1.2 million loan on it with a bank. And so we did a refinance where the seller financing came in and replaced the bank financing. So I pay off the $1.2 million bank loan. I bring in the private $1.6 million mortgage. And that gave me that $300-something thousand cash out refinance for this new property now, which was great because I needed more money for construction and tenant improvement allowance. And this property was now performing at a level where it could afford to make that mortgage payment. And so that was a way to kind of keep that private loan rolling and in place. And it's still there today. And what'll be funny is I'm thinking about selling that property. And, what's the next conversation with him look like? Does he want to move on to the next one? Can I get the next one lined up, nail the timing? Or maybe we'll pay it off and he'll just be happy to be, a debt or an equity partner on that next deal. It's hopefully, building a good resume and a track record with him.
And the another term for that is substitution of collateral, right?
Yeah. So you can say that loan that we have out has kind of stayed constant, but the building that's securing that loan and protecting his interest is what we changed. So yeah, what you're referring to and like what my mentor, Scott, and what he has taught a lot at Commercial Academy is that's a concept called substitution of collateral.
Yeah. We bought a building, like I said, a couple months ago, I guess probably 3 or 4 months ago at this point. And we made sure to put that in there, substitution of collateral clause, because it's 10% down, 5.5% interest, 25-year AM. So it's good financing. For sure.
Yeah.
So you touched on the structure, you touched on your portfolio a little bit. If you don't mind, I'm curious, would you be willing to share, just because I think it's inspirational to me and inspirational to our listeners, like kind of that deal you did sell, what you bought it for, what you did to increase the value, and then how much you ended up selling it for?
That one that we were just breaking down with the substitution of collateral?
Yeah, the one you mentioned you sold.
Yeah. It's funny because many of my deals are kind of similar price points and sizes and profit margins. So that one particularly was purchased for $1.65 million. It was about 20,000 square feet. So it was a pretty good price per foot. After it was, completely leased up, and we put a bunch of money into it, right? New parking lot, new sign, substantial tenant improvement allowance, leasing commissions, HVACs. There was hundreds of thousands of dollars invested, but that then sold for $4.65 million to a cash buyer out of California. And I think all said and done, that's a little better than $2 million in profit. And That was, I want to say 3-ish years from start to finish. What's kind of an interesting lesson learned on that one is I had the building fully leased and then had 2 or 3 of those tenants really go under, where we had to then release them again before we could go out to market. So I was sloppy with the tenant selection and a little too loose with the credit and the cash requirements. And it's something that has maybe helped me refine my buying criteria a little bit better and say, look, I'm gonna pay up a little bit more to get into some higher income parts of town with a little bit more durable tenants that might have, business models that are more relevant in 2025. So for example, an Herbalife tenant didn't survive. Selling $12 smoothies in a low income area is a tough one.
Yeah.
Same with like clothing boutique. Okay, well, are you getting enough traffic and buyers to come through here in the day and age where most of us are going down to the mall or we're ordering stuff online? That's tough for a clothing retailer to make it in today. Stick with the sturdy, tried and true tenants.
That's a good point, because I think some of us think of maybe on the outside, like, okay, like I just have to buy this building and get it leased and it's all good and roses. Like, no, tenants sometimes don't pay rent, and it's just because they're a business doesn't mean they're also going to pay rent either. So it's a good point. My question with that too is when you're underwriting these deals and you're looking at maybe a little bit lower income area, are you underwriting it as like, okay, worst case scenario, I know I can rent it for X square foot, but I could probably get, a little bit higher than that. Are you underwriting that at that worst case scenario? And how do you look at that?
I don't think we want to be too worst case scenario, but I do say, let's be conservative. So if you think, market rents are $18, I'd rather underwrite at 16 and say, does the deal look good at $16 rents? If I achieve 18, great. If I buy it up with some tenant improvement allowance and I hit 19 or 20, like this is probably going to be a home run, but let's make sure it still works at 16. And what I often think about is, am I the best value in a neighborhood? So if you're a tenant and you're looking around and there's 4 corners and 4 different shopping centers here, what's going to make you pick one versus the other? The intersection's largely the same. The access is largely the same. The demographics are the same. So you're going to, get in there and grind them on the rate and the TI allowance. And so I want to be able to compete there too and say, hey, we've got great active management. We're local. We're responsive. We're at $16 and we're offering, $8 a foot in tenant improvement allowance. And, the guys across across the street are at $18 with very little TI, well, who's the tenant going to pick? Unless you've got a far superior center over there, I think, and we can all figure that out, right? Am I the most compelling value proposition here? You'll probably get that suite leased. Or do I need to adjust my price or my incentives so that I am the best value in the neighborhood? And my other deal in Mesa, I had to do just that. I was struggling to lease it up, and I'm like, you know what? Someone drives 600 feet down the road here. They get into a bigger shopping center with more traffic, better visibility. If I was the tenant, I'd pay 18 there versus 15 at mine. So I dropped it to 14 and $12 and at least right up. So there's going to be that breaking point. Put your tenant hat on and say, for the extra $500 a month, I'd be willing to splurge to have that better traffic, that better visibility. I think I'm going to far recoup my money on that investment and just back that into whatever type of property and product you're working with.
Yeah, I think that's a great point. And what's so cool about commercial real estate and something that really stuck with me when I went to that event was the leases are the gold. So if you're looking at a property and it's empty, in commercial real estate, it's not going to be valued on the income approach where they're looking at the income it's producing. It'll be valued on comps, kind of like residential, if it's empty or vacant. Like what else sold empty or vacant. But if you fill it with a tenant, then you all of a sudden have an income stream that you can put a cap rate on and you can sell it for a much higher multiple. So something that's really interesting and I've learned over the years is like you mentioned this term, and I feel like a lot of people who are newer probably would just pass right over it. But you said buy it up. So you're talking about how you're willing to spend a little more money, let's say $8 a foot on 1,000 square foot suite, whatever that is. I don't know. Just, rough numbers. What is that?
$8,000.
Yeah, $8,000. Yeah. So $8,000, you pay $8,000, let's just say, to bump it up $2 a foot. But the NOI increase over a 5-year period is going to increase the value by so much more than $8,000. Who knows what the math would be, but by a lot.
Yeah.
So you just got to think about that when you are trying to fill a space. Is it worth it to come off the rent a little more, or is it worth it to spend a little bit of money out of pocket if you are planning to sell it or whatever, or even just the cash flow is going to be better. But I think that's just the point that's extremely important.
Yeah. And it's something to be mindful of as a buyer too, right? If you're going to go buy a property, has someone bought up the rent to an artificially high number that's not going to be sustainable when they go to backfill that vacancy when it comes due? So like a Starbucks is an interesting example. Great. You got a 2,000 foot building and they're paying $50 a foot in rent. Meanwhile, market rent is $20. And so when that term comes up, now you're sitting on a vacant, coffee shop that you're going to only be able to put a $20 tenant back into. So make sure that's in your underwriting. And I'll credit, I saw this on the strip mall guy, Twitter or the X profile. He's like, I like to buy it on price per foot and then sell it on cap rate, where someone else is willing to come along and pay a 6 cap for this. Cause we did that skillful work of finding it and negotiating a lease and doing any construction that's required. That's going to add $1 million or $2 million of value for a single lease in a lot of cases.
100%. That's a great point. I have a building listed that I won't specify where or anything like that, but these people bought it from out of state at a very low cap rate during the height of the market. Tenant went belly up and they left, and the price per foot they paid was like $500. Market price per foot is probably less than $100. And so the rent was like 35 or 36. Market rent is 10, 11. Yep. So, they're sitting on a building that's empty and they lost, they're going to lose a lot of money on that deal. So it's extremely important to make sure you're taking that into account. And just a good reminder. But talking about all this leasing and stuff, I know something that was the thing you presented on was how you market your properties, how you're able to lease them up quickly. It was definitely something that was a fresh perspective to me, doing YouTube stuff, doing Google ads, Facebook ads, and stuff we try to implement now just off what you talked about. So tell the audience a little bit about how you market your properties and how you're able to get them leased relatively quickly and find good tenants.
Relatively quickly is relative because it never feels quick enough. And it feels like sometimes I'm trying anything and everything and they still don't come. But that might be more a function of the property. And so, making sure you're buying something that's still in demand is going to trump any marketing strategy or campaign that you can launch, right? Like you can only create so much demand. And if no one wants that type of product, good luck. You can have the best, message to the right audience at the right time and it still may not matter. But what I would say is this, I know that, I make the most money and my investors make the most money the faster that we can force appreciation into the property, right? So if I go buy a vacant building or a half vacant building, I want to fill it up in, 3 months versus 12 months. It just helps everything get that much more lucrative. So what I found, like particularly in retail, probably the case in office or industrial too, is that brokers only have so much incentive to fill up the building. And if it's a 1,200 foot box and they're making a 3% commission on, a 3 or a 5 year lease, like they're talking about a couple grand. And so what are they going to do? Spend 20 hours a week calling, trying to find a little tiny tenant to put in there? It just doesn't, it's not compelling to them. My thought was, how can we make this more exciting for them, make it easier for them, be a little bit more proactive versus just react? And Graham, that's what got me interested in, I guess, taking some of my marketing stuff that I'd done in a past life and seeing if that made sense in commercial real estate. So I just asked the question, like, where do all the leads come from? Roughly a third of them come from LoopNet. A third of them come from broker, repped or known relationships. And then there's kind of like all the other stuff that falls in there. The sign calls and the drive-bys and this and that and the direct mail and the marketing. So it's like, all right, I believe in paying for paid premium LoopNet listings so that I'm number 1 or 2 in the search results when a tenant's hunting for a deal, or when a broker is hunting for a space for a tenant. I'd like to be there on page 1 at the top of the heap, and to pay $600 to $1,000 a month to do that was good ROI. Not every broker even agrees with that. They're like, I get so leads off here. Like I've had brokers say this, my highest quality leads are off of sign calls from existing business owners that already have a location and they know they want to be here. So they're calling on it because they're familiar with the property and they're just looking for the next opening. That's interesting too. But to your point, like some of the other things that are maybe a little less traditional, is I said, well, how can I find more of these mom and pops? Like I'm not in a hard corner shopping center. I'm probably going to be Joe's Coffee versus Starbucks. So how do I get in front of Joe's Coffee? I can go on Facebook, Instagram, and I can target business owners in a 3 or a 5 mile radius around that shopping center and show them that we have that space for lease. And so they could reach out on a call, they could fill out a form, they could do a direct message. There's lots of ways that they can reach out and just say, wow, I didn't realize that space was for lease. I know that center. I've been thinking about either relocating or expanding to a new location. So someone could do this, digitally with canvassing, but we could also fire up an ad and say, I want to spend 20 or $50 a day to do this. And what's funny is in this world of commercial real estate, I think not that many savvy digital marketers exist. Sometimes people are faxing in offers and letters of intent. So, we can do a decent job of putting our message out there and maybe get a outsized return on it. And you think, okay, so I spend $5,000 in ad spend to fill a space that increases my property by $250,000. Well, that just seems like a no-brainer to invest that kind of money in my marketing. But a broker can't do it, right? If they're only going to make $4,000 in commission, well, they can't spend $5,000 on ads. As the owner of the property, we can do some things and make those investments. It's like I just sent out some postcards as another way. Let me hit every business owner in a 3 or a 5 mile radius that leases retail space and just show them my flyer and let them know it's here. So similar idea.
Yeah. That's super cool. Cause I know why Graham asked that, cause I feel like me and him had the same conversation, like almost, I'll say 9 months ago, because so just background for me, I own a glove company and I've been doing Google ads and all kinds of stuff for a while. And he was like, we should make a Facebook marketplace ad for our building and boost it. I was like, oh, wait, actually, that's actually kind of a really great idea. And so we did it. And Graham, how many LoopNet leads do you think we got over the course of our 2 buildings?
Yeah, it's wild, like maybe 2.
Yeah. We had like hundreds of leads from Facebook Marketplace. We leased both of our buildings through Marketplace. So it 100% works.
Yeah. And I think it's very interesting because I still don't know where I fully stand on it, because back when the market was crazy hot, 2020, 2021, 2022, LoopNet was blowing up all day long. My phone was ringing all off the hook. I saw your property on LoopNet. My email with the LoopNet leads that come in was LoopNet. And I had Crexy at the time, and there was like a handful of Crexy leads here and there, but nothing like LoopNet. But then when, the last several years, 2 or 3 years, it's been kind of slow. Everybody knows, volume's down tremendously across commercial real estate nationwide. LoopNet has been crickets. And Crexy, for whatever reason, seems to be, we get quite a bit of leads on there. But when we put these properties on Facebook, it was like our messages were just blowing up, like you said, probably over 100 messages. So. Yeah. I don't know. I think a lot of it is more market specific. The market those two buildings were in were, tertiary markets, not necessarily like main markets. So a lot of the tenant base was, I don't know, more likely to use Facebook than be on LoopNet or Crexy. If that makes sense. Versus like our nicer listings in the Triangle area, I've got like 1 or 2 Facebook messages, but a bunch of Crexy. So I think it kind of varies.
And when I'm teaching, some of our students this, I say, like, who cares, right? We're agnostic from where the lead comes in from, right? So I'm expecting that I'm going to get some leads off of LoopNet. I want to have a presence on social media where people spend a lot of time. Why not put it out there on Craigslist for $5 and see if you get a nibble? And the more lines that we can put in the water, the more at bats and the higher probability of leasing, or hopefully the faster we're going to get a quality lead coming in. And I might add the caveat that, I'm finding that my higher, or maybe my more qualified and established tenants, tend to be broker represented, or they're often coming in off of LoopNet, and the leads coming in off of social media, or maybe more of the mom and pops, the guys just getting started. They might be, taking it from their garage, to their first brick and mortar location. So you need to underwrite them thoroughly, and you might have to kiss some ugly ducklings before you find your prince type of thing. But it's all viable. Like, think about, where are our tenants going to find that inventory? Where are they spending time, and where can we have a conversation with them? The same could be said for sellers. If you're looking for deal flow, right? Where do sellers go, and what message can we put in front of them that's going to bring them into our pipeline and our funnel?
I'm curious with the ads you're talking about spending money on. Obviously, you said you spend money on the LoopNet ads, but when you go on, for people who don't know, if you go on like Facebook Meta Suite, you can boost an ad on through Facebook and Instagram simultaneously, and it can be in the feed, it can be in the stories, and then on Facebook you can also do a marketplace post and boost the marketplace ad. So are you doing both? Or do you have a specific strategy when it comes to that?
I let the machine learning and the algorithm figure that out. So, when you're going into the portal to create your ads, you can say, hey, limit it to just this section, or put it in all of them. And then it will tend to pour the budget into the place that's performing the best, right? Facebook wants you to spend more money on ads, and so they want them to perform well, and they want to put them where their audience is clicking and interacting with it. So Marketplace can work great. Messenger could work great. The feed could work great. The video interstitial could work great. Like, different people are going to click on different things, and I don't really care where it comes from. And probably different asset classes and different markets are all going to behave a little bit differently. Unless you look and you see like, wow, that's a pretty weak ad, and it's so small that no one could barely see my building or my copy. I may opt out of that one, but otherwise, it's a relatively small budget to have that test and see what's getting clicks, what's getting interactions, what's getting performance.
That makes sense.
We were talking about LOIs and sending that and talking to property owners. Question I have for you, and the reason I'm asking is because I just saw this in a brokerage deal of mine. When you're sending LOIs and, property owners getting beat up all the time, how do you stand out when you're sending LOIs versus sending PSAs? Because I was just sending some offers for a third-party client. He said, okay, well, I get LOIs all the time. I sent him a PSA. All he said in the email back was signed attached. He signed it because he didn't think we were serious. I was trying to get him to say hey, my client is very serious. He wants to put in this offer. He's like, yeah, blah, blah, blah. Let me see it when it comes across. So instead of sending an LOI, I sent a PSA. He signed it. Do you think that there's something to that? Or is there, I know Commercial Academy always pushes sending LOIs, and that's the first time I'd really seen that. So I was curious your thoughts on that.
I love it. And I'm not saying this on behalf of Academy, right? I'm saying that's a great way to stand out. And, one of the reasons someone at Commercial Academy is going to suggest LOIs is because they're non-binding. No one's going to lose their earnest money deposit. So if you're teaching a brand new investor to submit an offer on their very first deal, we don't want them to get hurt. If you're a more seasoned or sophisticated investor and you don't mind, putting 25 or 50 or $100,000 of earnest money deposit up, and you're still going to have your due diligence period and you don't mind crafting a PSA, well, to me, that gives you a competitive advantage. it's one of the levers that we could pull on and say, they're going to look at the price, they're going to look at the terms, they're going to look at the due diligence period, they're going to look at your resume or your track record. Like, are you a closer, and decide like, hey, which offer, if there's multiple offers, is the most attractive to us. And so that's, I think, a great way to get a lower priced offer accepted, because you're like, hey, this person's willing to do a quicker look. They're going straight to PSA. They've closed 7 buildings around town, a lot like this. Let's take the one that's the higher likelihood of success versus maybe some unknown entity gives us an extra 50 grand on a $4 million deal. Who cares at the end of the day? Like, there's going to be that threshold where they take a little haircut for the speed or the certainty.
Yeah, for sure. And it kind of ties into just like what the seller's goals are and what's important to them, which is obviously a big deal when you're making offers. Like, is it just the highest purchase price? Because there's people like that who, there's people who'd say, I want that extra 50. I don't care if I have to risk it. And then there's people who like, nah, I'll take the 50 off and take the certainty of close. So I think that's a good point. And I think it's also too interesting because I've seen it from a broker's perspective. And, like you said, a lot of times you're dealing with brokers when you present an offer. Most brokers I know get maybe not annoyed by LOIs, but they much prefer obviously PSAs.
Yeah.
Because a lot of people do send LOIs just to fish, and they're not serious, which kind of ruins it for everybody else who is serious and just wants to kind of see where you can land on the deal. But yeah,
I think it's a great way to differentiate yourself. I did it recently because I kind of fell in love with the deal. I was in town. I drove it. This guy never sells. Ironically, I bought a building before him, and I said, hey, I'm going straight to PSA. I wrote it up. I spent the $2,000, with my attorney to get it drafted. And then I said, because I've toured this property, I'm going $100,000 non-refundable right out of the gate. And, I was assertive with my seller financing terms, and I was ready to do a quick close. But he didn't even entertain it. But that was something that I was like, I want you to know how serious I am about this. I am in a 1031 exchange right now. I showed him, my proof of funds and my resume, and I had my broker that he's known for 2 decades walk it in the door. Still nothing, but you just never know. I think that gave myself the best possible shot of, getting someone who almost never sells to maybe consider parting ways with the building.
Yeah. For sure. Jesse, before we kind of end out here, do you have any final questions for Sean?
No, I mean, we talked about a lot. I think there's only so much we can cram in here into an hour. I think the best way to do it would be to come to Commercial Academy. Yeah.
So that's kind of what we're going to segue into. So me and Jesse have interviewed quite a few people on the show from Commercial Academy. Me and Jesse both went to Commercial Academy last year. Him in Raleigh, me in Orlando, and it really opened my eyes, and it's changed City Ply a lot. So anyways, we've plugged Commercial Academy for free just because we were super excited about it, loved it, and want to be involved for a long time. But they actually approached us. We have been trying to get, we were talking to Sean about this before. We were trying to get Sean to come on the podcast. I'm sure he gets messaged all the time, so it's understandable that it just missed it. But Commercial Academy reached out to us, which is awesome, and said, hey, we're going to be coming to Raleigh. Would you guys want Sean on the podcast so we can talk about it and maybe give your listeners a discount to sign up? So we had already signed up for this event, by the way, which we're super excited for. So Sean, talk to him a little bit about the event that's coming up here in Raleigh.
Yeah. And thanks guys for plugging that. So, you mentioned some of the events that you've attended. What Commercial Academy has done for, well over a decade now is host events, 3-day workshops in live ballrooms. And so we do that, 4 or 5 times a year. It's coming to Raleigh here at the end of March, which I think is your guys' backyard. So it made a lot of sense. And it's fun because, the brokerage that you work at, City Plat, is inviting a lot of their colleagues, friends, family to come learn commercial real estate as well. So I'll be there to MC and help co-host the event along with some of the City Plat guys, which will be fun. And what we had set up for your show was a discount code for folks to be able to attend. So I think we called that Blueprint for you guys to line up with the show, so people can do that. And I'd say if anyone is interested in learning about commercial real estate, how do you buy a shopping center? How do you buy an industrial warehouse? How would you buy an apartment building? How do you go from a duplex to a 12 unit or a 24 unit? How does someone build a portfolio of 1 million square feet? How do they raise millions of dollars of capital? We spend 3 days unpacking that in a ballroom where folks can ask questions in real time and then network with other full-time, real estate investors and see how they've done it, look at a dozen different deals and case studies. And I know I'm class of 2014, by the way. So, for a decade, I've been coming to these quarterly meetings, seeing guys show their wins and their challenges and their stucks and their frustrations. And I think it's just accelerated, our ability to do our own deals. And then I think given a ton of confidence. And so I'd invite anyone to join us on there, and join Graham and join Jesse and the rest of the City Plat crew. We'll probably have a few hundred folks in the room, learning, networking, maybe finding partners. There's a lot of joint venturing that happens in the group too. And check writers. There's a real time Shark Tank or capital raise that goes on. So it's a lot of fun, and you'll learn a lot.
Absolutely. And, I'll just say that I joined City Plat about 2 years ago. I obviously saw them do a bunch of deals and learned a ton from them. And they've probably been one of the most influential things, just being at City Plat, learning from them. But, another right there with it, one of the most influential things on my career and journey so far was going to that event, because I saw person after person who, was also, they were great people, but you just looked at them and thought, oh, that's just a normal person. Like, they're just a normal human like me, and they're doing these crazy things. And it's like, it's just very inspirational and it's very eye-opening. That's probably the best way I'd put it. You go to one of these events and you're like, wow, holy crap, people are doing that deal. That guy just did that. That's crazy. And then you can slowly start to think, and this is what happened to me. I was like, I could do that. Like, I think I could do that. Not like not to be cocky. I wasn't being cocky. I was just thinking, oh, I think I could actually do that. Like, kind of just reinforcing that into my head. Whereas before it was more like, I could never do that. That's out of reach. But seeing people present, you're like, that's something that's possible. So I think that's massive. And then also, we talk about on this podcast all the time, like, you can listen to podcasts, you can read books, you can do all this stuff, but until you're in the right rooms with people, that's really one of the biggest accelerators. And being in person with people is so much different than phone call, email, text message. Sure. Being face-to-face with people is wild. And me and Jesse actually try to do podcasts in person when we can, because the connection that we build with the people we have in person is so much better than like virtual. So anyways, that's a long rant to just say, I would highly encourage it. We're not just saying this to try to plug it. Like, we believe in it, and it's been big influence on my journey. And I know Jesse's too. So definitely check it out.
I would completely agree with you, Graham, and add on to that. It's you hit the nail on the head when you talked about taking action, right? So everyone can sit back and passively absorb a podcast, watch a YouTube, read a book, which is great. But when someone invests a few $100 and spends 3 days completely immersing themselves and surrounding them, it takes it to another level. And it also really differentiates them from everyone else, because who doesn't want to own commercial real estate? Who doesn't want to have the passive? Like, that's everybody out there for the most part recognizes that we should all have some commercial real estate in our portfolio. But, a small percentage of people actually go out there and do it. So, kudos to, for you guys for helping to spread the good word, for exposing people to this. Cause I can tell you, like you, Graham, I had no clue that folks could buy multi-million-dollar buildings and do it, maybe with very little or none of their own money. Like, that was just completely unbelievable, frankly, until I had seen, dozens and dozens of folks all over the country and all these different asset classes successfully close all these deals. And I was just like, wow. It went from, I didn't even know it existed, to like building the confidence that, you could go do it on your own. If you, learn the skills and understand your underwriting and pick a good market and learn how to negotiate and do all the things that you guys are doing a great job of.
Yeah. Well, thank you. Thank you for, sharing that. And we're going to put like we said, we're going to put the link to it in the show notes. I think it's $497 normally for the 3-day event, but with the discount, it's going to be $50 off. And like you said, $447 for the kind of value you're going to get from this event, and the connections you'll make and the things you'll learn. It's an absolute no-brainer. So be sure to check it out. And Sean, for the people who want to connect with you and reach out to you, where's the best place for them to do that?
I mean, I'm a big LinkedIn fan just because I can kind of see what people have going on. If you go out to SeanKatona.com, I've got all my social stuff linked there, and people who want to get on my investor wait list, that's a good place to do it. If someone's interested in seeing my properties, it's simplifiedproperties.com, where I've got some of the current projects up. And then I guess if someone's interested in Raleigh, commercialacademy.com. And then what happens after that? Vegas. And then there's also a Cleveland event. So 3 different events in 3 different places throughout the rest of this year.
Are you guys doing the one in San Diego again? I know you did that last year, or no?
Raleigh became more of the regional one. Vegas is a pretty big one because it bookends the shopping center convention. And so that's just not a 3-day event. It also includes the boardroom, the mastermind group. And then Cleveland is that way too, where it can be 3 days to the public, 5 days for members. And then that Q4 event that we do is members only.
Awesome. Well, thank you so much. I mean, I learned a ton. I hope our audience learned a ton, and we appreciate you.
Likewise, guys. Thanks for putting this together and having me on. And it was a lot of fun.
Awesome. Thanks,
Yeah,
Sean.
of course.